Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everybody. This is an extremely special edition of Carson's Facts versus Feelings. This is episode 55 with Ryan and Sonu coming to you live from Nashville at the Excell conference with our partners. You just had the honor of speaking with our esteemed guest here, Sonu. You want to introduce? We are so excited. I know by the way, he hasn't slept for like a month. I mean, he has been so excited about this.
Yes.
Go ahead.
He's one of my 9 fans in the world.
There you go.
No, we had like Captain Quant as some. So I told, one of our advisors who's here.
I love how you still didn't announce who it is. You're for the podcast crowd. You're drumming up suspense who this is.
Right. So. Captain Quant, Cliff Asness, right?
There we go.
I fancy myself or have fancied myself. I think I've given up on trying to be a quant some time ago. But at the time when I first got into business, Cliff was the one to look up to. So absolute honor to have you here, Cliff.
Thank you.
No, it is. I mean, so Cliff, we'll go 30 minutes or so, have some fun here, goofy questions, some real questions. We'll just have a good time. But a lot of financial advisors listen to this podcast. We've been doing a podcast for about a year now. And, you work with a lot with financial advisors over the years. You sure have. I mean, one of the things I think, of course, we had this question at this conference. If you have a client, how can you really know if that's the right manager, if that's the right strategy, if they're bullish, is it really a bullish strategy? How can you kind of quantify that for somebody to make it truly what they think they're investing in?
First, just leave at the door the idea that you can know with any certainty.
Yep.
There is no magic bullet, but we know the work to put in. I think the number one piece of work to do, be it about manager selection or even a client's overall portfolio, is how much uncertainty there is in the world, and how if you do smart, good things, you win over the very long term, but you have parts of the ride you don't enjoy at all. And increasingly in my career, I mean, I always knew this. It's not rocket science, but the importance of getting that right, of having people understand how often something's going to work and how ugly it can be when it doesn't work, even if you're right. I have elevated that in my career to number one. It used to be on the list, but there's no magic bullet to it. You sit down with every client and you take them through the range of historical outcomes. If you're honest, you point out that historical outcomes do not mean nothing worse can ever happen. I'm fond of telling people when they look at, quote, worst cases, be they back tests or live returns, I'm fond of asking, what was the worst case before that happened? And it wasn't as bad, right? So if you are looking at historical worst cases, so there's definite art to go with the science here. So what I'm mainly doing is filibustering your question and telling you it's super important, but I don't know a magic answer.
Nicely done. You've done this once or twice.
Thank you.
One more from me than Sonu, because it struck me. You mentioned the word mistakes, and I love this question. Sonu's probably going to get the real in-the-weeds questions, all of the bigger questions about how you see the world. What's one of the biggest mistakes you've made? Now, I don't know if I'm even talking about investing or running a very successful business, but a mistake you've made that you've really learned from that you can, at this conference, I talked to a lot of people who are probably 25 years old, younger. They love this podcast. Like someone younger, what's one of those mistakes that us old guys have made that they need to learn about?
Sure. I'm going to go back 25 years to when we launched our firm. There have been plenty of mistakes before and since. I'm not pretending that was, the only error I ever made. But we spun out of Goldman Sachs as a team. At Goldman Sachs, using a series of quantitative models, we ran both alternative investments and traditional investments. And within both of those, we ran them at whatever risk and aggressiveness level the client wanted. Turns out when you go to launch your own firm, it's pretty hard to launch 11 products at once. You pick one. And ironically, launching a traditional low tracking error, beat the benchmark, product, which we absolutely did and still do, is really hard. People go, we'd like to see a 5-year track record. They look at you and they want you to look more like I look now than when I look then.
Right.
And the years have not been fully kind. It turns out, at least in the distant past, but I think still somewhat the case, maybe less so, that going to the world and saying we're launching an aggressive hedge fund, suddenly 5-year track records, age, all you had to do is tell them you were closing. And it was the path of least resistance. It may have been the only path, to be honest. And it was absolutely something we did at Goldman, so I don't feel bad about it to that extent. But we launched the most aggressive version of what we did. Our first product at AQR was a market neutral, meaning short as much as it's long, trying to account for so-called beta also. It's not like you're really trying to be uncorrelated to the market, but super aggressive. My version is super aggressive. I'll do geek speak, 20 to 25% volatility. Substantially more volatile than the naked stock market standalone. Just when it makes and when it loses money shouldn't be the same time as the market. We hit one of our worst patches ever, 1 month into business. We launched our first fund in August of 98.
What were the odds of that? I mean, you do the numbers.
Apparently,
like
100%.
100%.
It depends on your view of the universe.
I got you.
But August of 98, August 3rd, we launched our fund.
Okay.
First business day of the month. August of 98, Russia defaulted on its debt.
It's always Russia.
It's always Russia, isn't it?
Always Russia.
You took my
Yeah.
joke. I actually, whenever this comes up, which it does occasionally, I always say that. The S&P, I don't want to quote the exact numbers because I'll get it wrong, but it was down somewhere in the order of 20% that month.
Right.
I often joke, half jokingly, half serious, refer to this as the crash nobody remembers. And why does no one remember it? I got theories. It wasn't any single day wasn't gigantic. It was a string of bad days. And it came back fairly quickly after that. So there was no magic newspaper October 19th of 87.
Sure. Right.
And lasting pain is remembered a lot more than fleeting pain. One day, maybe March of 2020, we still remember that because it's very salient,
Sure.
but maybe that one will fade a little bit. A 10-year bear market is hard to fade. We had a fairly strong August when the market was way down. So never congratulate yourself or celebrate. It's another thing. I'm a very, you'll notice I'm an oddly superstitious quant.
Okay.
You asked me before, I said 100%.
Yeah.
The other thing is celebrating. So we're sitting around going, we claim to be market neutral. We made a lot of money at Goldman Sachs. Markets are down 20%. We're up a little. We were bitter because we would have been up a lot, but we have to get our strategies on gradually. You can't just put them all on, but we're
Right.
up. We're celebrating. And then this thing called the dot-com bubble basically was already going on, but really took off the next month, September of 98, and ran through March of 2000. This is actually, I don't know if we're going to talk about it, but very,
If
very
you bring it up, we're talking about it.
was a very similar period to 2019 and 20, maybe even parts of 18, where anything that a value manager, and value it's not a majority of what we do, but it's a big factor. It's one of the biggies. Doesn't dominate. We go through long periods where value does poorly and we do well. I don't even want to consider the opposite, but I could imagine it doing well and us not doing super well. We prefer cheap to expensive, but we care about a lot of other things. Turns out when value suffers, like for instance, I'm going to go all the way up post-GFC. Value is terrible from 2009 through 2017 without harming us whatsoever because everything else we believed in worked. Because it wasn't a bubble, it was just a bad period for those companies.
Yeah.
When value doesn't work because what I will self-servingly call a bubble, people are just out and out, freaking out, selling the cheap, and FOMO is driving the whole world. Your value part of what you do is terrible, and the rest of your process, which is designed to pick up the rational reasons value might not work, it's not a rational reason. So we hit that period right from the get-go, after one decent month. Again, remember this was a market-neutral fund, so you get no lift from the market going up, taking north of 20 vol. So we were down in the mid-30s on our first investment product from a standing start. Now,
Right.
we're all sophisticated quants in this room. It was not much more than a 2 standard deviation event. If you're a Vulcan about this, and you're Mr. Spock, you're going, oh, 2 standard deviation events happen all the time. We've seen positive
back.
ones. It turns out, to a quant geek, maybe they're indifferent between losing 36, versus a quarter of that. Most of the rest of the market seems to care.
Yes, they do.
So
Yeah,
I would be going around telling people, it's a 1.8 standard deviation event. We made much more than this. We had triple-digit years at Goldman. It's what we signed up for. And people would say, you're down 36%, dude.
Right.
So the mistake, which is a long-winded way to finally get to the mistake, and this is on me.
Is that even what I asked you?
Yeah,
I don't even
it was
remember
a
what I
while
asked you
ago.
at this point.
This
Yeah,
happens
no,
with me a
this is
lot.
awesome.
You'll have
No,
one
this is
question, the
awesome.
podcast will be over.
I mean, so I haven't even talked yet. We're like halfway done. I love it. This is great.
No, I can just listen.
Exactly.
The mistake was we didn't have to do this.
Mm-hmm.
I probably, you do a road show for a new fund. You go out and you talk to investors. You're a standing start. You have to convince people what you're going to do is good. There were probably 20 investors who said, we love what you're doing. I won't tell you about the ones who didn't love it. But 20 investors who said, we love what you're doing, but we don't need 23% vol, whatever it was. How about half or a quarter of that? To a person, I gave a flip, quantitatively accurate, but deeply ignorant answer. They'd say, we'd like this, but at a quarter of the risk. I'd say, give us a quarter of the money. And to this day, I refuse to apologize for the math. I'm 100% right on the math, but I missed the point entirely.
Yeah.
Everybody reports to someone, the principal agent part of the world, where you have to show, I invested in this thing, and it's down 4 times more than it would have been if you'd done. So it would have been the simplest thing in the world to say, you guys who want 23% vol, we'll do it, and if you want 5%, we'll do it, and it would have been a far. I would have 5 more years at the end of my life if we had done that. So that one's still mad at myself about that one.
You mentioned the word bubble. Are you comfortable with that term?
I wrote a whole piece in the Financial Analyst Journal. I know you've read this because many of your questions were taken from this.
Yes.
I wrote a piece on my top 10 things that annoy me in finance.
Yes.
This is very hard to cull down to because I have a very long
have a
list.
lot.
One of them was overuse of the word bubble. If you watch business TV, which I don't generally recommend, but if you do, somebody will come on and talk about a bubble in a single stock they don't like. There's a big difference in saying we think this company is overvalued and bubble. My definition, which I made up, I admit, but I think it's a pretty good working one, is we have tried very hard to come up with any assumptions that are within the ballpark of reasonable based on either forward-looking economics or long-term historical data that could justify these current prices. And if the answer is no, and that should be very rare, because while I'm not a perfect efficient marketer, I don't think they're that easy to beat either. And when they're easy to beat, they've been excruciating for a while. But so that's my definition of a bubble. I think I've seen 2 in my career. I think the dot-com bubble, I'm calling it the dot-com bubble, so I'm kind of giving it away.
There you go.
And I think at least by late 2020, post-COVID, that cheap versus expensive stocks were, depending on the way you sign it, in a positive or a negative bubble. I don't think there was any way those prices could be justified by any subsequent results that were within the realm of reason. I didn't call the real estate crisis in the GFC. We don't really do real estate, so I don't feel particularly bad about that one. But that may be a candidate for a bubble too, but they're a bit bigger experts than me. And probably the one before that, maybe the Japanese stock prices in the late 80s. One of my 2 dissertation advisors, Ken French, had a paper. I love this story. It was back in the 80s. He wrote a paper that said the working title, because when you write an academic paper, sometimes it's 5 years till you get the darn thing published. The working title was, Are Japanese Stock Prices Too High?
Wow.
The title when it came out was, Were Japanese Stock Prices Too High? That's a true story. So that might be a candidate also. But, I love Jeremy Grantham's work. He sees 50 bubbles in history. I see more than Gene Fama and less than Jeremy.
And Gene Fama is your advisor.
Yeah, he was
just
my
for
dissertation
everyone,
advisor, and he's partly why I still feel guilty saying the word bubble. Even the ones I believe were true, I feel like Gene's going to yell at me, and I'm going to have to apologize. which is entirely possible.
And G Pharma, for all our listeners, is I think we should call father of modern finance, the one who, I don't know, is discovered the right
I'm
word?
biased, but I think that's fair. I think I call him the MVP of modern finance. I think the efficient markets hypothesis, Gene will tell, that's that prices reflect all information. Gene will tell you, he tells the class, that's almost certainly not true in the extreme, but I think it is the scaffolding we start with for everything. You know, and it's a great starting point, because there are a lot more ways to mess up your portfolio and your lifetime investing experience by thinking markets are very easy to beat than by thinking they're impossible to beat, even if impossible is not true.
Sure.
So I think Gene is the MVP of modern finance.
And got the Nobel Prize for it.
He
as
did.
well.
He did. I would have given it to him 15 years earlier, but you can tell I'm a little annoyed about this.
Peeved, yes.
Peeved, yes, thank you.
So we've hit about the halfway mark of episode 55, Carson's Facts versus Feelings, talking investing lessons with Cliff Asness. I just came up with that title. I think I like that. I think I like that. 'Cause we didn't have a title
like
yet,
that.
Chelsea, did we? But we just came
Yeah.
up with that. I think that's good. Cliff, you know, we were so excited to jump into it. We didn't really, I mean, most people know you. We didn't really give you a chance to just talk about yourself, what you do all day. Go ahead and take it away. You know, you obviously have a, however you want to take this.
How
For
far
people,
back do you want me to go?
As much as you want, because there might be
as
someone
you
on this podcast who's
Born
never
in
heard of
Forest
you.
Hill, Queens in 1966.
Really?
The Beatles were still a group and the Vietnam War was still going on.
Okay.
Just to
Alright.
put it in perspective.
Yeah.
Roll forward to college. I went to college. I thought I was going to be a lawyer because my entire family were lawyers. I shouldn't tell you this, but I have a,
No one's listening. Go
I have a
ahead.
distant cousin who was John Gotti's lawyer. So if anyone, this is an 80s deep cut for some people, but I thought corporate law. I was at the Wharton School as an undergrad. I didn't think Mr. Gotti needed a Wharton lawyer particularly, but at some point during college, I was studying engineering and at Wharton. My dad actually said to me, "Why are you going to be a lawyer?" I'm like, "Dad, you're a lawyer. I always assumed I'd be a lawyer." He's like, "But you're good at math. You're going to waste that?" And there, at a very similar time, I just got very lucky. I was doing some research assistant work for some Wharton professors.
And approximately what year was this then when you got
is
lucky?
87.
Okay, 87. Okay, got it.
One of the professors I worked for is a guy named Andy Lowe, who went on to be one of the stellar lights of modern finance. He's up at MIT, still active, still brilliant. But I really liked what they did. I only did this job for money. I could code, and so I took a part-time job coding. But then I'm like, this is cool stuff. And then I said some stupid, naive stuff like, what if I want to do what you guys do? And they're like, well, did you notice we all have PhDs? And I was a little slow on the uptake. One story, I'll get in trouble with my Wharton alum contacts, but I went to about 10 professors and said, where should I go get a PhD? And 9 of them said, shut the door. Because, and this may have changed dramatically. These rankings are not necessarily the same as they were 35 frickin' years ago. But Chicago and Stanford, and maybe MIT, were the 3 places everyone recommended. And Wharton was much more about an MBA than a PhD at the time. Again, I'm not going to say anything about today. It may have changed. But that was why they said shut the door. They're going to recommend the school. And 8 of them recommended Chicago, and 1 of them recommended Stanford. And he had a guy who came from Stanford, another great academic named Robert Litzenberger. I'm telling you too much. This is, again, you asked me one question, I go on.
No, this is
I think I ended up
wonderful.
at Chicago for the stupidest of all reasons. And it's a wonderful place, and I got very lucky. But Chicago had in their budget to fly out students like myself for a visit to try to kind of sell them on the school. Stanford did not. And those were the 2 I was really choosing between. I didn't have any money. I went to Chicago, where it was
Chicago
free
chose itself.
to visit.
Yes.
I visited the University of Chicago on a gorgeous spring day. Greatest bait and switch in the history of academic recruiting. And I am fond to this day of saying I'm the world's only person to choose Chicago over Stanford on the weather. Which
yes.
I may
Right.
not have been quite that stupid, but directionally I was at least in that direction. Went to Chicago, ended up being Gene's teaching assistant, and then Ken and Gene very graciously agreed to co-chair my dissertation. My dissertation was combining their strategies. It was very early in them investigating systematic value with momentum, which was not a very Fama-esque strategy, right? Buying what's been going up and expecting to keep going up. It's not a very efficient market strategy. I was not the first. There are others who did it, but I was very early in studying that. They were very good about it. Gene, when I told him I want to write a dissertation on momentum, it was very nerve-wracking. I was actually scared. This is one of like the most scared I've ever been in my professional life, was telling him that, thinking he's going to be like, that's not what we do here at Chicago. And he said, just very straight, if it's in the data, write the paper, which I took to be a very meaningful comment. His respect for data is that large. Ended up writing a dissertation on quantitative stock selection, focusing, and it's expanded since then, but largely on the value and momentum strategies. Took a job at Goldman Sachs. I had one of my best friends and an ex-Wharton professor both worked at Goldman Sachs, and asked me to come first for a summer, then for a year. At the end of the year, and you asked, I'm giving you too much auto.
No, this is awesome. No, I'm loving it.
Again.
What year was this, can I ask? When
This
you
is
started?
91.
Okay, so bull market was still kind of just starting. It was still
there were
going.
bear markets
still
in between. 90
we had the
was
87
a
one,
big
but yeah.
recession. But,
all right.
Anyone who's happy where they've gotten to in life, who doesn't admit there was a fair amount of luck along the way, is probably lying.
Yeah.
Right.
I wrote a paper, the first paper I ever published on my own in the Journal of Portfolio Management, called Option-Adjusted Spreads and a Steep Yield Curve. I'm sure you've seen the Netflix movie.
Yes.
PIMCO, famous bond manager out on the West Coast, read it, and they liked it. They asked me, we talked for a bit, and they ended up asking me if I would start a research group there. And I told them I'm writing my dissertation on equities. You guys are a fixed income shop. And they're like, no, we do those too, and we're looking for a very general quant. We're looking to import academics. There's a little bit of irony here too. I think half of Wall Street wanted to import academics because of the then success of the hedge fund long-term capital. And no knock on them. They, but they obviously ran into a lot of trouble years later. But everyone on Wall Street was saying, hey, we need this. Turns out all of us academics did not do the same thing, knock on wood, but it was probably part of the impetus. But I went to Goldman, and I said, by dumb luck, trying to choose between going back to academia. My professors wanted me to go on the job market and become a professor. Goldman, I was doing well. I was doing okay there at least. Wanted me to stay. PIMCO came along and suggested the perfect marriage. Do a research group applying academic work to actual real-world situations. And a light bulb went off, and I said, that's why I get the best of all worlds. I get to do the same kind of research. I get to see if it actually works, not just works in theory. And I get, paid Wall Street salary, not professor salary, which anyone who tells you they went to Goldman Sachs instead of becoming an assistant professor, who does not admit that that mattered a little bit to them, is also not telling you the truth. And I went to Goldman and said, very honestly, I'm thinking of doing this. And they said, we're thinking of starting a group just like that by coincidence. And to this day, 30 years later, I cannot tell you if that's true or not. But it worked out.
You spoke about momentum, and that's what your PhD dissertation was about. And we talk a lot about momentum, like, buy things that go up, sell things that go down. Why does it still work? Like, you think everybody knows that. It seems natural. Like, you just buy stuff that's going up, sell stuff that's going down, but it still seems to work.
A few things. First of all, in isolation, it is quite a scary strategy. Momentum, particularly price momentum. Momentum, since my dissertation, and not just through my efforts by any means, has greatly expanded to be not just various versions of measuring where prices are doing, but also fundamental momentum. Those, thankfully, are fairly correlated, right? The fundamentals are getting better and better. More often than not,
So
the
if a
prices.
company is doing better in terms of...
But not always,
profits,
yeah.
all
Earnings,
that.
margins, sales, forecasted, whatever. So both forms of momentum, subtler measurement, but viewed alone, and I think too many people view strategies alone. I think that is actually, talk about investing lessons, probably the number one investing lesson I can ever come up with is have as long a term horizon as you possibly can, because the short term will always be crazy. But a much more micro one is worry about your whole portfolio, not each line item. Not that you shouldn't look, not that you shouldn't be on top of it, but often the individual line items are there to wiggle the other way. And too many times people are like, why do I have this part when the other part's going really well? Well, they do that with factors too and styles, and momentum viewed alone is terrifying. Toby Moskowitz, a colleague of mine, a Yale professor, has written directly on this, on quote, momentum crashes. Momentum viewed alone, if you just buy what's been working lately,
Yeah.
it has a really bad left tail. Sometimes the world radically reverses out of the blue.
And it can crash.
And that is true even if it's a very good strategy that on average makes money. It looks kind of sawtooth. I'm drawing something with my hand right now. It goes up, 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 drops, up, up, up. And if you add it all up, that could be a great long-term ride.
Right.
And if you blend that with other factors, principally value, but other quality factors, other low-risk factors, you don't have to take that much risk on momentum standalone. But I think much of the world still judges things by line items.
Interesting.
And it's so scary that I think it scares a fair amount of people away.
I think it's a good lesson for everyone. Like, focus on the whole.
Yeah.
And how
It's hard,
the
hard
pieces
to do, but
interact.
great if you can do it.
Yeah.
As opposed to each piece of the pie. Go ahead, Ryan.
We've got maybe 10 minutes or so I want to get to some of the really fun stuff. You seem to have a love-hate relationship with Twitter, X, whatever you want to call it.
Yeah, what are we calling it?
Whatever we want to call it. I mean, do you really enjoy getting on there and getting yelled at and getting in beefs with people, or is it? We love your persona on there, by the way. We're a huge fan. I mean, Sonu, it'll be 1 o'clock in the morning. Sonu sends me a text, look what Cliff said. I mean, he just loves it. So it seems like you enjoy it, but hate it. Explain that. Circle that, square that up for us.
You just explained it. I enjoy it and I hate it. The enjoyment brings you back, and the hate it makes you quit occasionally. There are things I absolutely love about it.
Yep.
This will sound arrogant and highfalutin, but I like teaching about this stuff.
Yeah.
I teach classes. I go back and I go, various professors I've interacted with at the time, they're like, I go and I do a lecture whenever I can. I'm into it. I'm a proselytizer. I love it.
Yep.
And some of the dialogue you get on Twitter is just great. It's either someone who is very open-minded, very nice, but doesn't know something, and I do pride myself on those occasions really taking time to explain. Sometimes it's other kind of fairly high-level quants, and you get into even if it could be a debate, it could be agreement, but sometimes the conversation is great. I do have my dad. I don't know if they use this term anymore. It's an old-school sports term.
Okay.
When I used to play ball as a kid, never very well, but I played. He said I had rabbit ears. That term meant you listen to the chirping of the crowd too much. If someone in the crowd is saying you stink, you'll yell back at them. When the cool cucumber kind of player just ignores that. So that's always been part of my personality.
Interesting.
Twitter's a bad place for someone with rabbit ears, right? Somebody just chimes in, and believe it or not, I mean, you can go through the tweets. There are tons of things that I don't respond to.
Sure.
Every once in a while, I'm having a bad day and someone's a jerk.
Yeah. It happens.
I've gotten better over time. I will say that. I used to respond to
Is that because compliance yelled at you, or did you really get better?
Both.
Yeah, I figured. Yeah. I know.
It's not so much compliance.
It's
more overall.
Right.
I had a client call occasionally saying, "Could you not yell at people as much?" Don't get me wrong. You're right.
There you go. That's the
you're,
boss
You're
too.
right.
The clients are the boss.
We love what you're saying.
Yeah.
Just
tone it
pretend
down
to be nice. And my defense was always, I think this is true. I'm super nice to people who are nice to begin with. Sometimes I'll go through gigantically lengths to try to get a point across. But a lot of it was just personal, though.
Oh, yeah.
It doesn't add to happiness to get upset, even if I can't help it at times.
It's funny when you talked about the rabbit ears. Like, I've got 2 boys, and they both play basketball, and they'll shoot free throws. My youngest is Gus. I'll say not mean things, but I'll try to say things to get him fired up and right initially. Shoes untied, dinosaur behind you. Just stuff to mess with them. And he doesn't even notice it. My middle son, he just loses.
Everyone's wired
exactly. It's just amazing how people wire differently. So just kind of fascinating. But Sonu, we've maybe two more questions or so probably here for Cliff. So
But since
go
we
ahead.
have investing lessons, I know you're a hockey fan. Are you a hockey fan?
I'm really not.
Yeah.
No.
So
And
don't know.
you admit that in public freely.
There you
In
go.
public, I guess
And
so.
in front of
I mean,
Cliff.
yeah, in
Right.
front of Cliff.
I didn't know much about
Maybe I
hockey.
will be after Cliff answers this. How's that
So
sound?
one of is it your most cited paper, pulling the goalie?
It is the most downloaded paper on something called the SSRN, which is kind of
Really?
the central repository for unpublished working papers.
Working papers. So you wrote, this is about the Miracle on Ice, 1980.
That was
the
part of
US,
it, yeah.
US was playing Russia, 1980 at the Olympics, and the US was up. There's a bunch of college students, amateurs really against the Russian players. Who
I get a little teary every time I watch the movie.
So,
Yeah, that Kurt Russell,
with good reason,
Kurt Russell
with
line
good
off
reason.
the Kurt
He's
Russell
perfect,
thing. And
too.
he really
Perfectly
was.
cast.
I mean, Kurt Russell
And the US
amazing.
is leading 4-3 with 10 minutes to go. And, the coach, the Russian coach, did not pull the goalie. It's a dramatic move in hockey, as I learned from your paper. So I wouldn't have any idea. But talk about that. What's the investing lesson that you drew from
Well,
looking into
the history of this paper is I had an idea for a way to model what the geeky optimal time to pull the goaltender is. And for anyone who doesn't know, if there's 10 seconds left in a game and you're down by 1, it's costless if they score again. It's a bad idea to not play with a goaltender in general. If you started out the game without a goaltender, their advantage, you have a higher chance of scoring because you have 6 skaters, but they have a much higher chance of scoring because there's this gaping empty net there.
So it doesn't matter if you're losing 1-2 versus 1-4.
You would never do this in a tie game
Yep.
because you're giving an advantage away. But once, and here's your first investing analogy. With 10 seconds left in the game, you're an out of the money option.
Yep.
You're going to lose. Them scoring is not going to make you lose worse. Maybe it's more embarrassing, which, by the way,
Pride.
people raise as maybe a real world issue that I'm not in our model. But in terms of winning the game or points in the standings, it's irrelevant. If you really want to be obnoxious, often like the 17th tiebreaker for playoffs is like how many goals you've given up, which is a tiny, tiny, tiny flaw in our model, which I know you're going to bring up, so I preemptively did. So you would pull the goaltender with almost certainly with 10 seconds left. Go back to 20 seconds. Now it gets geeky. You say, I'm going to act optimally. I know there are 2 possible things that could happen in the next 10 seconds. We broke the world up into 10-second increments. I could score, actually 3 things. I could score, they could score, or nobody could score.
Yep.
What are the payoffs to each of those, assuming I do the rational thing in the last 10 seconds? And then you can just work your way back. And it tells you when the rational thing is to pull the goalie. It involves some assumptions, as all models do. These assumptions were pretty solid. They're like fraction of times people score, fraction of times people are scored against when they pull the goalie. And the answer came out to maybe you should pull the goalie with 5.5 minutes left in the game.
So if you're losing,
If you're
say
losing
1-2,
by 1,
Okay.
nobody does that.
okay.
Historically, probably when I started watching hockey, they did it with about a minute left. That's probably moved out directionally. I don't take any credit for this, but directionally, it's moved out to maybe a minute and a half, maybe even 2 minutes for some. You don't do 5.5 minutes. And in fact, our model says, and I'm actually fairly, not confident with the exact number, but I'm confident with the logic, that if you're down by 2, you should pull the goaltender with 11.5 minutes left in the game.
That's a long time.
And that sounds ridiculous, but you have lost the game.
Right.
In a probabilistic sense. If you score quickly, you'd actually put the goaltender back in.
Sure.
Because now you're down by 1 with 9 minutes left. It's too early to pull the
Right.
goaltender. So, and we showed this was worth, it's not a huge thing, which is partly why it's not arbitraged away and partly why the whole world doesn't agree with us. And it was worth about a point a year in the standings.
And that's what matters, right?
It's a free
the
point.
standing.
It's whether you make the playoffs.
Right.
The really interesting question, by the way, I thought we were super original in writing this. And it turns out there have been quite a few papers written on it, but they were mostly by Canadians. So we got the
They don't
U.S.
count.
credit. No, they're great papers. And funny, they all did it very different than us, but almost all of them came up with a fairly similar conclusion. And that makes you even more confident in your result. Robust ways of looking at the same thing say they're not doing it early enough. Where it gets interesting in investing is, I'll phrase the question this way, and you can see the applications, I think, to investing immediately. Why do people sometimes not do what they know is the optimal strategy?
Yeah.
And, we talked earlier about viewing parts of the portfolio. Let's say you add a high volatile part of the portfolio that you will get yelled at and fired if it goes down a lot.
Because you're different from everybody
Because it's
else.
different than everyone else. But you look at the math, you believe in your assumptions, and it's making the portfolio better. And in the sports world, there are a lot of these. We've only written on goaltending. In football, some of the famous ones are, and this has started to change a lot. This is kind of cool, where geeky findings. My colleague Toby Moskowitz wrote a whole book called Scorecasting on behavioral finance and our kind of statistical techniques applied to sports. And some of them were original, some of them he was just cataloging. But football teams generally don't go for it on 4th down enough. If you're at like the 40-yard line, you're talking about an expected 20-yard difference versus a punt. If it's 4th and 14, probably you don't go for it. But if it's 4th and 3, and that's actually started to change the football world. And
Yes.
they found really cool things. In hockey, I don't think enough people have moved yet to find this.
They don't read the papers.
Well, you believe it? I'll tell you a story about that in 1 second. But in the football world, I believe one of the findings was older, more respected coaches who've built up a lot of human capital act more optimally. And they argue the causality does not go that they become respected because they act optimally. Optimal is great, but it's not that powerful.
Okay.
They argue, and I find this very convincing, that they act optimally because if they're wrong, they're not going to get fired. Right? It's a rich get richer kind of thing. Bill Belichick, if he goes for it on 4th down and fails, New England Savage, the New England papers, they're going to write bad things
Sure.
about him. He ain't losing his job.
Sure.
First year coach does that, very well might lose his job. And when you come to investing, we have already talked about a bunch of them. I think there are tons of things where we can all theoretically agree this is right, but it's hard.
Yeah.
And the good news both in sports and investing is hard creates opportunity. The world where something is easy and works really well, if it ever exists for fleeting amounts of time before too many people do it and it goes away. So we all want a world where we find the easy to stick with, pleasant strategy that also makes us a lot of money. But I think most of us get paid long term for doing something that ain't that easy. And I think the sports analogy is a strong one.
Well, Cliff, I think that's probably a really great way to end it. This was a true honor.
Oh, it was
to
fun for me.
discuss. I mean, honestly,
you, guys.
Sonu and I we didn't talk. This was the easiest podcast we've ever done.
That's not
we
the
just
only
sat
time
back
I've heard
and-
that in my life.
We just sat back and like, wow, this is the best podcast we've done. It's because we didn't talk. I don't know what that means,
I'm not sure my family feels the same.
They've heard the hockey story once or twice.
Once or
Yeah,
twice.
but the partnership with AQR and Carson is awesome. It's only going to continue to grow.
very
It means a
excited.
lot to us that you took the time to come to Nashville to hang out with us and obviously talk with Sonu on stage a little bit ago and now on our podcast, Facts versus Feelings. So it means a lot to us. So everybody, that was episode 55 of Carson's Facts versus Feelings with Cliff. That might have been the best one we've ever done. So thank you
thank
so
you.
much. We'll
That
see
was a
everybody
ton
next
of
week.
fun. Thank
Take care. Bye-bye, everybody.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.